we'll use a mortgage example. What's the best way to? So the effective interest method, say we'll use these bonds as an example, straight line. Interest method. Just so you understand it, you need to know that this exists. Let's say this was $1 million home in the Bay Area instead. Fair? That sounds like it can maybe get me a condo in the Bay. We would say this is the value of our mortgage. And then we can say interest. Let's see. Value of our mortgage. We'd say we want to. Our interest rate is 3%. That's the market interest rate. And we want to figure out how much we're going to pay. PMT. So we can figure out the PMT. Google Sheets. Normal mortgage is periods is 30 years. You pay it monthly, right? Monthly. So what does that mean? We multiply this by 12. 360 periods. Figure out the payment of a $1 million mortgage. You use this formula. Payment is the rate, 3%. But we need to change that for interest rate monthly. Divided by 12. Our rate is this. Our number of periods is 30. 360. Our present value is $1 million. Our mortgage payment is, this is how they calculate mortgage. This is how the bank calculates your mortgage payment. So now you just did it. If you borrowed $1 million on your home, it's a 4,000 and a 3% interest rate. It's $4,216 a month. What does that mean monthly for your balance? So what does that mean on, and this is what installment payments trying to get you at. Installment 1. So on month 1, our value mortgage, original value is 30. We then are going to take interest is this times there. We're going to pay $2,500 in interest. Principal is going to be this $2,500. So our first payment is going to be mostly interest. It's going to be $2,500 in interest. And then our principal payment is going to be $1,716. So beginning value, ending value. That means my mortgage, I owe $998,283.96 on my mortgage at the end of month 1. And so installment. Plus 1. Now my beginning value is $998,000. We're going to take this times the interest rate. And then this minus, I guess I plus this, and then this plus this. I can make a formula for you to see how this kind of plays out over time. So we can just make this +1 and go down ad nauseum. Down all the way 360, and you get a mortgage amortization schedule. You can see this is what an installment payment is. And you just calculate it. You can see on period exactly 360, we will pay off our mortgage. What does this show you? This is called the effective interest method. This shows you that what our payment towards interest decreases over time, and our payment towards principal increases over time. But we're majority paying for interest for our mortgage for most of the first 15 years. We don't wind up paying more principal until after about 15 years. What does that mean our total value we're paying is? We're paying this $1 million plus all of this interest. So our mortgage actually costs us some equals. Our mortgage is actually costing us $1.5 million, about. Right? So we're paying about $500,000 in interest. That's what we're getting at here. That's how they're calculating it. You take your beginning balance, you multiply it by your interest expense for the period, and then less your payment, and that's how much cash payment actually goes against your principal. This is how banks do it. Like, if you can do this, you can go work for a bank and figure out mortgage payments. So the point here is that your principal that's the installment payment, will be reduced a little bit, which will change your effective interest payment. What does that mean from a journal entries perspective, right? We always have to go back to the accounting. The interest component, this will be our interest debit. This will be a debit. And then this will be the payment, which is always going to be this. Or credit. A journal entry. Our payment doesn't change. This 4,216 doesn't change. That's going to be our credit to cash. And then we're going to debit interest expense, and then we'll debit our notes payable. And this is how the journal entry would be from an effective interest perspective. This is called the effective interest method. This is about as hard as it gets from a journal entry perspective. I know accountants that struggle with this. So if you're that graduated college, so if this is making sense to you, you're in really good straits. If you're struggling with it, understand this is a difficult concept, and you'll get exposed to it many more times throughout your college education. So that's all this is saying is you debit your interest expense, you debit your notes payable, you debit your interest expense by the interest expense amounts in this formula, you debit your principal by the principal amount, and you credit your payment. I'll give all those numbers to you on the final. Okay? I'm not going to ask you to make this schedule on the final. Even though you have the Excel sheet, I'm not going to ask you to do that. On your homework, you might be asked to do something similar so you can practice the concept. But on your final, I'll give you the amount so you can figure out the journal entry, or I'll ask you high-level concepts, like how is the effective interest method different than than regular amortization? And you would just have to tell me or select the answer that the principal payment and interest payment change over time.